Friends, we've all heard what is a SIP. SIP stands for Systematic Investment Plan. It's the way you create long-term wealth and corpus for yourself, right? But today I'm not going to talk about SIP. I'm going to talk about reverse SIP. What? Reverse SIP? I've not heard that term. Yeah, that's exactly what I'm going to talk to you about. But first up, this product is mainly for senior citizens and people who require an income from the investments. Now let's look at what problems they face. As a senior citizen, I would like to keep my money reasonably safe. I'd like to keep it parked somewhere where I know the outcomes are going to be predictable and I'm going to get something on a regular basis, monthly basis to live my life with. Those are the three conditions as a senior citizen look forward. Unfortunately, the bank or the FD rates are very, very low today. On the other hand, the stock market offers plenty of high returns. Unfortunately, it doesn't work very well for my heart because it keeps going down. My portfolio goes up, I'm very happy, but when the portfolio goes down, I'm extremely sad and I'm very terrified of what my value of my investments is. Friends, that's where this reverse SIP as a concept works brilliantly. Let me explain. Mr. Khanna, who recently retired, wanted to put aside 50 lakhs of rupees and wanted to start generating a cash flow. He decided against FD, but he also decided against equity mutual funds, both of which were two extremes, devil in the deep sea, so to say. We gave him an option where he looked at these hybrid funds. And typically hybrid funds are a combination of debt and equity. Now these could be, for example, these could be about 50-50%, let's say as an example. On a 50 lakh investment, let's say he put it in a hybrid fund, which has a 50% equity and a 50% debt. The equity component over long term would generate about 12%. The debt will generate about 6%, say as an example. The weighted average of both this would give him a 9% return. Much, much higher than what he would get in the bank. Now, how would Mr. Khanna operationalize this? First up, he'll identify a very, very good, consistent hybrid fund that has a good track record. He will then park this 50 lakhs in that fund with a growth option, not a dividend option, a growth option. After a year, knowing that the fund has accreted, on 50 lakhs, he may have made 2, 3, 4, 5 lakhs or so. As an addition to that, we would then set up what is called a reverse SIP. That is a systematic withdrawal. The systematic withdrawal normally we would recommend is a small discount to the rate we expect to earn. So in this case, if the rate that we are hoping he will get over a 5-year period on an average would be 9%, then we would say he should draw about 6% as a monthly cash flow. So on a 50 lakh, 6% works out to around 3 lakhs. And on a monthly basis, that works out to 25,000 rupees per month. And that's really the amount that he would get to draw on a month-on-month basis that will come back into his account. This way, every year, Mr. Khanna will be able to compare how his investment has performed. The 50 lakhs he has invested, he has drawn 3 lakhs out, and whether the portfolio continues to be above 50 and significantly growing. And once in 5 years, Mr. Khanna can also increase the amount in line with inflation. So he starts with 25, maybe after 5 years, he sees that he needs 30 or 35, and he sees that there is a nice buildup of the corpus, so he can also draw additional amounts. So the reverse SIP as a concept works brilliantly for senior citizens. And what more, it is also tax efficient. Unlike an FD rate where you get taxed on this, reverse SIP, because the amount coming out consists of both the principal and the return, is very, very tax efficient. So it is the go-to product for people, especially senior citizens, who are looking at a slightly better return to what they're getting in the bank, more predictable, don't want to take risks as you would do in an equity mutual fund, but want something better than a bank deposit. reverse SIP through a hybrid fund is a great option. Advantages of reverse SIP. Fairly simple, a steady amount keeps coming to your bank on a monthly basis or a quarterly basis as per what you have planned. There is no change, there is no speculation. Is that amount going to be different this month, lesser, more, nothing of the sort. Second, it's far more tax efficient as compared to getting it as interest and paying 30% tax on that. This is much more tax efficient because what you draw out is a combination of interest as well as principal, a small amount of it. So it is very, very tax efficient. Third, very simple to set up, change, stop, alter, all of it can happen seamlessly. There is no fixed model in this. So it's very, very easy to operate. Those are the advantages. But there are two things that you need to remember about this. One is a reverse SIP, because you set it up, you need to make sure at least once a year you review. What is the amount I have invested? What is the growth and how much have I drawn, so that you ensure that you are not taking money, the money that is coming to you is not from the principal but from the return. That's extremely important. Second up, because it comes, you draw the money out, it is considered as a capital gain, and because it is considered capital gains, there is a set of documentation that happens at the end of the year for taxation purposes. Little bit more cumbersome, but it's something that you will have to live with. If you want a more tax efficient return, you will have to live with a little bit of cumbersomeness on the capital gains aspect. So if these two are done, reverse SIP can actually be a great tool for senior citizens to keep drawing money for their everyday needs on a long-term basis, especially in a scenario where bank interests are low, safe investments interest rates are low, and equity market is doing phenomenally well, but it's too risky as well. So this one provides the best of both worlds.